Hello, my name is Karan Singal. Here is my ID, and today we are going to talk about my Capstone project, which is titled Short-Term Trading Models with Signal Precision. Firstly, financial markets. Now, financial markets offer many kind of risk premium, but there is an inherent challenge, which is about how to mesh the historical data plus the theories, the experiences, and the current market conditions into one coherent framework. Fortunately, some of the terminology has been standardized, and a couple of frameworks are available for investors like left tail versus right tail, risk on versus risk off, as well as some of the more sophisticated frameworks like the Cube framework. This Cube framework, which you see on the left-hand side of the slide, is developed by Antti Ilmanen, who is a portfolio manager at Brevan Harvard. It thinks of strategies in terms of three different dimensions. One of them is asset class, whether it is equities or credit bonds or government bonds. The second dimension is about styles, which is about things like trend following or value or carry and volatility. The third dimension is risk factors, which is effectively an overlay, whether it is about growth, tail risks, illiquidity, and inflation. So, a concrete example would be you can have a trend following strategy on stocks, which is mostly about growth stocks, or you could have a government bond value strategy, which is about managing the inflation regime shift. So you can have a different strategy on one inflation regime and a different one in another inflation regime. The scope of this project is going to focus on trend following strategies in equities markets. Now, trend following has been existing for quite a while. What it means is buy when the prices are going up and sell or short when the prices are going down. And there are both rational as well as behavioral explanations for this particular thing. It people started observing trend following in commodities as an asset class, where the theory of storage or and relative stickiness of the inventories helped explain momentum effects, which meant that prices, if we were going up, they kept on going up because it was hard to replace the inventory in a short span of time. Another explanation that was mooted was the strong performance of energy commodities. Although this benefits from a benign sample period where oil was increasing in price and because of growing demand, especially from China. Now, what happened in this situation is that this price movement was, you know, contrary to the supply demand fundamentals, i.e., the price started going up and the expectation was the demand would come down, but given China was growing so fast, the price kept on growing, and that basically meant a momentum strategy was a much more dominating player compared to the supply demand fundamentals. Empirically, two interesting observations were made. One was momentum strategies, and in particular, commodity trading advisors who implement these strategies have a negative or a low correlation to equity markets, as well as with other styles. Momentum strategy also operated best in the 3 to 12-month window, with mean reversion more prevalent in the sub 3 month and value being more prevalent in the greater than 12-month category. Now, these are the rational explanations. On the behavioral side, this is basically about investors as a group extrapolating past returns initially and then overreaction to some popular stories later on, which were the underlying cause of behavioral cause of these trends. If you look at the chart, as you see, the before the increase in the green line, markets are trending sideways, and you see that there's something that has happened which should have led to fundamental value change, but not all investors have made that movement in the stock price. So the black line has risen by only roughly half what the green line suggests it should rise. Now this is because some of the investors are still extrapolating the past returns, i.e., they are underreacting to the news initially. Now, when this trend in terms of price becomes sticky because some investors have already started the price movement, they notice this price movement, and then there's a subsequent overreaction. Hence, the price goes beyond the green line, continues the trend, and that is what explains some of these momentum strategies. Now, what is the basic setup of our work? Our strategy is simple. Trends are most easily identified using moving averages, and we're going to use moving averages for our project. These moving averages, however, have a particularly important choices to be made impact profitability. The one which is about whipsaw. Well, a couple of things that can be done to mitigate this. We can use two moving averages instead of one, and which approach seems to have worked in both bear and bull cycles alike. And we are going to start with expecting moving average of 21 day as the fast moving average and the expected moving average of 45 days, which is going to be the slow moving average. And we apply it on the index and a set of stocks. We also calculate a few metrics like RSI and average true range. We plan to overlay market conditions and apply some positioning techniques like percent vol positioning or market size positioning. Now, how did the basic performance look like? The blue line is basically the buy and hold long S&P index strategy since 1993, and the red line and the orange line is the strategy. Now, for this 25-year period, for a strategy which was based on two stocks, this strategy was performing particularly poorly. Well, what happened? Well, when we look beneath the hood, there were three things that were impacting the performance. One was we were in and out of the positions too much. Went from straight long to straight short, and that was creating a lot of whipsaw. There was money which was lost on the short position side, which was very frequent and was not compensated enough, whereas money gained on the long position side was still being compensated. These observations were consistent not just on a sample or a handful of stocks, but also index itself. So if you, in this chart, you will see that we still have the S&P 500 in the blue line, the strategy is in the red line, and the strategy over a 25-year period has not grown beyond the double. And the green plus and minus one is, as you can see, there's a frequent whipsaw. I mean, what is most notable is in the like 4-year bull market period from 2011, 2012 onwards to 2017. I mean, we have been in and out of positions, whereas it would have been better if we just stayed long in those positions. And on the short side, there was some increase in the value of the strategy in the 2008 period, but normally, whenever the strategy is meant to be short, we haven't really gained too much money. It has at best stayed flat. So we look to refine. Now we have done a couple of refinements. The first wave of refining was to reduce the whipsaw. So what we did is we refined the signal and we refined the EMA windows. So expected moving average windows were refined to 10 days for the fast one, 50 days for the slow one. The long position was tinkered to fast moving average greater than slow moving average, and the current price is also greater than the fast moving average. On the short position, the inequality signs are changed, but roughly it's the same. Well, we also tinkered with one more assumption, which is why not we go long only? And there's a reason for that. The reason is that we have many kind of market participants. We have central banks, real money clients, which are asset managers, pension funds, and as well as hedge fund clients. Now, real money clients have a much larger assets under management compared to hedge fund clients. Noticeably, hedge funds do have leverage, but overall, real money clients are the ones which are more stable in nature and tend to be more sticky in terms of their position taking. And the results on the right hand side prove that this is actually working. If you look at the orange line now, which is the strategy compared to the S&P 500, which is the green line, the orange line seems to be increasing relatively monotonically fashion. I mean, the limited drawdowns and it has grown to 4 times in the 25-year window, which is a good sign. We also went to do the second wave of refinement, and some of these adjustments were mentioned in the peer review. One of them was, why don't we use the average true range? So what we did was, in the long position, we added an extra criteria, which is about fast moving average greater than slow moving average plus 2/3 of the average true range, as well as the second condition still says, which is current price greater than fast moving average. Why 2/3? Well, there was a trade-off between the size of average true range window and the number of positions. And 2/3 is the point where it did not impact the number of positions too much, and we could see what is happening. We tried to bring back the short position signal using VIX as a proxy, but that did not increase the performance materially. So we basically stuck to the long only positioning. So how are the results and the metrics looking like? We have a win ratio of 41%, i.e. 2 out of 5 positions are winning. which is understandable because of how the strategy is designed. You have, relatively lot of small losses, you know, and a lot of large gains. That is the expectation. The mean position return was 2.23%, and the CAGR was 6.15%. Um, but more importantly, if you look at the drawdowns, which this strategy scores like head and shoulders above the S&P 500, with a maximum drawdown of just 19% compared to like 57% drawdown of the S&P 500. This is a much better risk reward ratio, and this is also visible in the Sharpe ratio, in the Sortino ratio, and the Kalman ratio, which is quite encouraging. Now, the natural question is this approach transferable? I.e., does it work outside S&P 500? Now, we tested this approach against Apple. Apple benefits a lot from having risen like multiplied like 700 times in the last 25 years. Well, if you look at the orange line, which is our strategy run on Apple as a one individual stock, this performance still holds, and there's a good balance of risk and reward. What I mean to say is that we have average growth rate of 21%. Lake ratio is very tiny, 6%, which means our strategy rarely goes into losses. The Sharpe ratio, Sortino ratio, Kalman ratio are particularly good. Now, there is a variation of the strategy which can increase the performance even further because we pick the market money model for positioning, and we only invest 80% of our profits into any new positions. If we increase that to, let's say, 100% of profits are eligible for position taking, the CAGR, especially in the outer sample, jumps up by 20 further percent, which goes up to 25%. So, on a risk reward ratio, this is slightly on the conservative, but it's generating a lot of alpha in terms of risk versus reward balance. Now, this is about testing the strategy on a handful of stocks. What about portfolio construction? Now, there are a couple of ways to construct the portfolio. We can pick the top 10 market cap stocks, but that is driven primarily by the FANG issue of technology sector taking a large share of that portfolio. We could pick one or two stocks per market sector, but we run the risk of hidden correlations between tickers, which will hurt our performance. But there's a couple of other approaches which we have learned in Alpha 3 machine learning courses, and we could use some of them here. And we use one of them, which is K-means. What we did was we picked the prices from all S&P 500 tickers. We extracted the features, which was pairwise correlation. And from each grouping, we selected the stock with the highest market cap. And the results on the right hand side is basically the pairwise correlation of the 10 tickers across 10 groupings. So there's not many which have greater than 0.5 correlation, which is quite encouraging because these are top market cap stocks picked using machine learning language and with low correlation amongst each other, which should hopefully give us a different type of positions to pick for our trend following strategy. Uh, we also added transaction costs and benchmarks. We picked the Deutsche Bank Equities Momentum Index as a like-for-like comparison. In terms of transaction cost, we picked the transaction cost as 2 basis points per trade, which is based on the McKinley Capital report. This did not make a big difference, although the CAGRs went down by roughly 8 to 10 basis points over the lifetime of the trades. Which is understandable. Why is that? That the overall CAGR did not go down too much is because we are very selective in our position taking, and the total number of positions, for example, in the in sample period are 90 and out of sample period are 120. So because we are taking on an average fewer positions per year, that is why we have kept the transaction cost impact in check. Now, what are the final results? We have picked 10 stocks from K-means algorithm. We have designed a strategy which works in a long only trend following strategy. And we constructed two portfolios, which is about odd number stock and even number stocks. And you can see that this strategy works. The orange line works in both cases as a bit more stable set of returns. The green line, passive buy and hold, still outperforms on the return side, but if you look at some of the drawdowns, investor would have to be really comfortable with those drawdowns uh, before it works. And the metrics support that theory. In the out of sample, and when I say out of sample, I basically split the sample for each setup portfolio into half the time period it is in sample, and the second half of this time period it is out of sample, and we see that the Sharpe ratio, Sortino ratio, Kamo ratio are all better compared to the rest of the portfolio constructions. We also see that the win ratio is pretty handy, which is about 60%. The maximum drawdown is fairly contained to 9%. The lake ratio is pretty low because it's not a diversified portfolio. Remember, in Apple case, we were talking about lake ratio of 5 to 6%. This is much, much lower. And we maintain the CAGR, healthy CAGR. We can obviously, rack it up a little bit more by still reinvesting 100% of profits. But I think this overall end to end is a good strategy. So in conclusion, we have defined our signals for the trend following strategy applied to indices. We have created a dynamic set of portfolio which can be created based on k-means groupings and apply highest market cap stocks. We have made sure that the performance is basically taking into account the selective set of positioning to avoid whipsaw, which has shown that we have good results across the board. I hope you enjoyed this video, and thank you, and leave any comments if you have.